but that's kind of the point, is that very specific topics, very specific advice. And if you're interested in this stuff, you'll be on it. And if you're not, you can ignore a class. So I think next week we'll have another class coming up that hopefully you'll really like as well. What's the next week, Kendra?
Oh, I say I don't have the title of the next week's, but I know you said you may not stick with the list that we had.
Oh, I'm such a troublemaker. Let me see what the next class is.
Keeping me on my toes is what you're doing.
So some of the examples, I have a class on multiple offers, using an LLC to hold property or own property. A lot of people with that, in that particular circumstances, they hear the advice. Someone tells them, hey, you should be putting this in an LLC, but they don't always know why. So I think it's a really important thing to know the why, and then you can make a decision whether it works for you or not. I have a class on flood zones that I've already written. I have a class about when family members or friends or whomever wants to give money, say a gift towards down payment or earnest money deposit, things like that, how to kind of work that out, how to think creatively to avoid some hiccups that can happen last minute at closings. I call that the bank of dad or the bank of mom. They're trying to help their kids buy a house and they want to just give them the money or they want to loan them the money, but there's certain restrictions on that. I have a class on legal descriptions, on option money, temporary occupancy exhibits. So evictions, evaluating closing attorneys and lenders, adding someone to title, and then 1031 exchanges. So there are a lot of really cool topics. I've got about 30 listed. So we'll do probably, I think Kendra and I have a schedule for the next month and a half or so on different classes, but it's hopefully you'll find a few that you really, really like.
Those all sound great.
Yeah, so this is Fix and Flips, and this is part 2 of the Fix and Flip. Last week, we talked about the financing piece of it. We talked about, my favorite ways to buy a fix and flip or even a rental, anything that you're using as an investment property. And honestly, the cheapest, simplest way to do it is to get a loan from an institutional lender, go talk to Silverton Mortgage or whomever you work with, and see if you could apply and see if you'd be approved for a conventional loan or an FHA loan or even a VA loan, and what the cost involved with that would be. So, the only downsides with that is that there are closing costs up front, but really that's no different than if you did a hard money loan or many of the other options. It's just a lot of people assume that you have to have it in cash or have a partner that's going to co-invest in order to afford it. But the reality is, if you're going to fix this property in 3 or 4 months, and maybe it takes another 3 or 4 to sell it, you've got 6 to 8 months of interest payments that are pretty minimal. If you're buying a $150,000 house and you're getting a $120,000 loan, that means you got to come out with $30,000, maybe another $30,000 in construction costs, or maybe even $50,000. So you're all in between $50,000 and $80,000. And then you got a mortgage payment to cover the $120,000 loan, which is a 30-year loan. You could hold on to it forever, or you could sell it quick and get your money back. But it's pretty cheap. And interest rates on investment properties, this is September 2020. Interest rates are, in the 4s, sometimes even in the 3s. We're seeing 3.5% interest on an investment property over 30 years. So that's pretty incredible. If you're borrowing $100,000, that's $3,000 a year in interest. And you'd spend 4 times that amount, 10 times that amount if you did some of these other options. But one of the other options that we talked about pretty strongly last week was when you invest with a partner. And I cautioned you against doing it. I said, you just don't need it. And I really implore you to think that way, because it is hard to own and make money on real estate. And it's harder when you're doing it with someone who's not your spouse. It's sometimes even hard to do it with your spouse. But if you're dealing with someone who's not your spouse, even if it's a brother or a parent or a friend, a college friend, they just have different finances than you. The best example I can give you is an HOA or a condominium association. So one of the things everybody loves to hate on HOAs or condos, they don't think they do enough. They think they're too expensive. It's just a pain in the neck. And, you know, they're just overbearing at times, or they're underwhelming. It's one or the other. They're either doing too much or they're doing too little, too expensive, or not doing anything at all. That is no different than having a partner. And the other example or analogy would be if you have a partner in school and you feel like you're doing all the work. It works the same way. And to think that it's going to be any different is a little naive. So just keep in mind, if you're in a partner with someone, test the waters before you go all in. Rent before you buy. So we talked last week about investing in someone else's deal before asking them to invest in yours. So you could be a lender on a deal and watch from afar. You could say, all right, I'll invest $20,000, and then the next time you could do the 100,000. But you really want to know what this person is all about and what kind of decisions they make. And one of the other examples I can give you is just with my wife and I would love to replace the garage doors at my house. I think it would just make the house seem so much newer, and it would insulate better, and it's really not that expensive. But my wife looks at it as they're garage doors. Are you joking? And she thinks it's crazy. And having a partner is no different. The thing that's even more complex than that is my wife and I have the same bank. We have the same amount of money available to us. So we're making decisions with the same information. But you and a partner, you're going to have different financial status. Maybe your partner is going through divorce. Maybe there's trouble at work. Or maybe they just made a ton of money on an investment elsewhere, and now they can overspend on this other piece. And that can be pretty uncomfortable for you. So setting out standards, doing some of the things that we talk about in this class, hopefully will kind of, if you decide to go this route, that you'll have a bit of a structure to be successful. You still want to be present. You still want to keep your partner accountable. You want your partner to keep you accountable, but this will give you that basic structure to go forward. So co-investing is, one of the ways we do it. So you'll be expected to fund at least a portion of the transaction, either upfront fees, down payment, and/or the rehab budget, or overruns, or in your case, forfeiting your commission. So that's one way you can get into a deal without really any money out of pocket. So I see a lot of clients of mine that will have a client that wants to buy a flip, needs some investors, and the real estate agent says, all right, I'll invest. I was going to make $12,000 on commission on this deal. Well, I'll forward it and I'll waive my commission. We'll get the price down from the seller, and that'll be my contribution. I love that. I think that's an easy way to get in without going all in. Obviously, make sure your spouse is okay with that. Number 2, consider loans over equity partners. We talked about that. If you can structure equity partners to be paid like lenders with some upside potential. So this is the hybrid approach. So obviously, if you have a lender, the way you would structure that deal is you'd say, all right, you give me $100,000 and I'll pay you 10% interest. That's kind of the starting point for interest. So anytime you talk to a partner or an investor, start at the 10% number. And if it's a really safe deal with a friend of the family and they just want a good investment, you could start at the 10 and be like, well, it's a great deal and this is a safe thing for you and there's no risk and you would be paid back in no time. Let's do 7%. And maybe the equity investor will agree to that. But if it's a risky deal, if they don't know who you are, if this is your first deal, then the interest is going to start going up. Maybe it has to be 12% to peak their interest, or maybe it's 15%. But I am seeing, if you've got a builder or a rehab person that's good at this, is maybe a dozen or a couple, maybe 20 or 30 of these under their belt, they've been doing it for 10 years, they can get that interest rate down to 8 or 9, maybe 10%, as opposed to someone who's brand new who might be at 15%. And that's kind of the balance that you play. And the hybrid is the equity investor that gets a preferred rate of return. So let me explain what that is. I give you $100,000 and I'm an equity investor. I'm not a lender. So I want to share in the upside, but I want to protect my downside. So this is the way I structure the deal. I say, I'll give you 100,000, but I want to be paid first an 8% return on my investment. So, we sell the house, we make some money on it, and from that profit, first I get my 8% investment back. So I get my 100,000 plus 8,000. Let's say it was a 1-year hold. So I get my $8,000 plus my $100,000 original investment, and then I'm also going to share in the additional equity that's still there. So it was, let's say we made 20,000. You just paid me 8,000 on my investment. Now there's 12,000 left, and we're going to split that 50-50. And that is that's called a PREF, or a preferred rate of return. And that's a way to allow someone to invest like a lender with potential upside. Now, as a person that's putting the deal together, maybe you don't want that. Maybe you just want to give them 12% because you think the upside is a lot higher. Or if you really can't pique their interest because they don't like being a lender, they don't think an 8% return is all that interesting to them, and they want more like a 20% return. Well, you don't want to guarantee them a 20% return. That's no fun. No one wants to do that. But you guarantee them an 8% return and a split of the profits. And it doesn't have to be 50-50. It could be a 12% pref and a 20% of the profit, or an 8% or a 6% pref with 80% of the profit. You can move that around based on what kind of leverage you have. And building this interest in your product, in your ability to make money, you're going to get better terms the more you go. One of the things that you can also do is, as you get great at this, is that you can basically shop that around and start buying down your rates. So, maybe you can get a better split, you can get a better interest or a preferred rate of return before you start making money. Maybe you can build in an acquisition fee. Maybe you don't have to forfeit your commission. So you tell your investor, you say, I'm going to buy this property. I'm going to take an acquisition fee or a commission, right? That's my acquisition fee. So I'm going to make a commission up front. I'm going to use your money to build this property out. You're going to get your preferred rate of return, and then we'll split the profit at the end. And by the way, I'm getting commission on the end as well. So you're building in the purchase commission, the sale commission, and you're getting to share in the profit. You can give someone great returns and benefit yourself really, really well on a deal like that. So that, and a lot of times what they'll require is that you co-invest something. Co-invest, when I did subdivisions and other commercial properties, my investors would always ask us to put up 1, 2, 5%, something like that, somewhere in that 2 to 5% range, maybe even more, maybe 10%. Or if I really like the deal, if this was an awesome deal, I don't want investors. No, thank you. I'll just do the whole thing myself. So keep that in mind. It's a really neat way to kind of play with it. So there's an example there. As an investor funds $100,000 and receives a 10% preferred rate of return on that money when the property is sold. In addition, investor splits 25% of the remaining profit. So if you made 20 grand on the deal and it was a 1-year hold, you're going to pay them the $10,000 of their interest. So they get their $100,000 back, they get a $10,000 interest return, and then they're going to get $2,500 as that remaining profit. So you would make $7,500 on that deal, plus commission on the front and commission on the back. So you can come out pretty well on that. And then we talked about some of the alternative financing solutions in the last class, so go back to that one if you have questions. But self-directed IRA, lines of credit from your existing home, hard money lender, conventional lenders, things like that. So now we've got someone on the line. They're very excited about investing in you. And now what do we have to do? We have to put it in writing. And this is where a lot of people make the first major mistake. So maybe this is the second major mistake, because the first major mistake is assuming that you need a partner. Maybe you don't. And if we go down this process and this partner makes you better, then okay, I will support you and we'll get this partner, but let's make sure we do the second thing correct. Mike Campbell, who is the founding partner of Campbell and Brannan, he says something that I just think is awesome. He says, marry up, partner up, show up. That's how you do well in life. So marry up, that's pretty self-explanatory. You're going to marry someone who makes you better or is better than you. Partner up, it's the same thing. You're going to partner with someone who makes you better or does something different that brings more value. And then show up, you've got to actually show up and do the work. It doesn't work if you do all that, unless you do all those things. So now that we have that, we want to put that in writing. And so you need an operating agreement. Now, you need an operating agreement because what you're going to do is you're going to buy this as part of your LLC, limited liability company, or an S Corp or a C Corp or some sort of partnership. But you're going to form an entity to hold this real estate. And I think I have other classes coming down the line. One of them in particular is called Owning Property in an LLC. And we'll probably get more into detail as to why we need to put it in an entity. But the quick summary, the quick elevator pitch is, if you own it in an LLC, your partner's financial or personal issues will not affect the ownership of the property. So if I own it personally and I'm getting a divorce, my divorce can put a hold on the house, like a title hold. And you can't sell it unless the divorce is satisfied. Well, if you own it in LLC, the divorce doesn't come into play. It's not relevant for selling the property or refinancing it. So even if your finances seem to be fine and you don't have those issues and your partner doesn't have those issues, you could get sued any day of the week. And if they're going to sue you personally and you own the house personally, you could have a real problem selling the house. And that would be a disaster if you're working with a partner who's either doing that to you or you're doing it to them. That's how you get sued twice. So we put it into an entity, say a limited liability company, and we want to sign an operating agreement, which is a partnership agreement. This does not have to be perfect, but it does need to exist. Way too often, family members will go into business together without some sort of agreement, something in writing, and it's such a mistake. You would think maybe initially that your family is the one party that you don't need it to be in writing, that you can take those additional risks. Actually, I would flip that on its head and I would say family is the one time you should have it. And if you decide not to have it on someone else, I'll understand. And here's my reasoning for that. You have to maintain a relationship with family. I mean, most part. You can't disown your mother because she screwed you on a partnership deal. You can do that to a friend or an associate, someone that you don't live with or know long term. You can cut them out of your life and never see them again because they really did you wrong on a deal, on a real estate deal. But you can't do that with mom. You still have to go to Thanksgiving dinner. You still have to show up to holidays. And you can't allow some disagreement to ruin that relationship. It's just not acceptable. So you put it in writing and you say, here's what mom is going to do, here's what I'm going to do, and this is our purpose. And if it doesn't work out, then this is how we sell. This is how we get ourselves out of it. And the nice thing about it is it sets the stage. It makes it, at least for one moment, you are on the same page about this real estate deal. And if 6 months goes by and things are going badly, you go back to mom, you say, Mom, this was our original agreement. Okay, yes, honey, I agree. This was it. And then this happened. And it allows you to at least agree on something, that you have this starting place. Where if you didn't have that, and you go to mom, you say, Mom, remember when we bought this? You said you would do this and I would do that. And she'd be like, I don't remember that. That's not what happened. You never did that. Like, you can see the point that roles and understanding of what was discussed, it just changes, it morphs over time. And so put it in writing, put it in writing, put it in writing. So the biggest things that need to be addressed: roles and responsibilities of every member, profit distribution, decision matrix, which is like a decision tree. So if this, then that, if this, then that, if, you know, or I will do this, you will do that, and very specific role allocation. And then contributions from all the members. So if you're contributing your commission, if you're contributing money, labor, project management, bookkeeping, some sort of service, is all needs to be spelled out in the agreement. Because if you just assumed that you were going to be the listing agent and you were writing that into the deal as like, all right, I'll at least make my 3% on the sale, and it's not in there and they want to work with someone else, or they sign a listing agreement with someone else, that's a real problem. It's a real big problem. So obviously, put it in writing, put it in writing, put it in writing. And then letter C there, as things change, update the agreement. That sounds self-explanatory, but a lot of people just don't go back to it. They forget to update it as things change. So let's look into each of these pieces of the partnership agreement. Now, before I go too much further, the reality is most people don't think this hard about the partnership agreement. They download something online, or they just do a quickie thing, but really spend the majority of your time putting it into writing. This is what you're going to do. This is what I'm going to do. It is really that important. So first thing I would look at, roles and responsibilities. These must be strictly defined with remedies and solutions available in the event a member fails in their duties. So here's an example. Member is to project manage or manage the project, and shall provide weekly updates with pictures, budget updates, and must personally prove all work before being sent to bookkeeping for payment. So this is an example of something that I do in my partnership agreements because I've seen it go badly when you don't do this. So when we built subdivisions, what we would do is in our partnership agreement, it would say, here's what your role is, here's what my role is. And we'd have a budget built into the partnership agreement. It would say, all right, the purpose of this LLC is to divide this property and sell it to a builder. We are projecting to spend this amount of money on this project, and see attached Exhibit A budget or projected budget. The members are not required to fund anything beyond the budget. And then we had a specific thing about bookkeeping, saying that for any work to be paid, it had to, one, be in the budget, and two, if it's under $2,500 and the work has been completed, it gets paid. If it's over $2,500 and the work has been completed, it needed at least 2 estimates. And you can change that number. You could say it's $500, or you could say that it's $5,000. Or you could just take it off entirely and say, if it's in the budget, you're allowed to just write a check. But you don't want to be the money man who is working full-time at Atlantic Communities or doing your other projects, and then come back 3 months later and realize we are spending things that are not on the budget. We're going way over budget because we're not getting multiple estimates, or the person's doing the work themselves, or things like that. So it's a real balancing of responsibility, because the way I would love to see you do it is, one, it's in the budget. So here's the hypothetical. We're going to renovate an old ranch house in Cobb County, and we're going to spend $150,000. We're going to spend another $50 renovating it, and we'll sell it for $250. So there's $50,000 worth of profit in there if we do this right. And I've got a budget that's itemizing $45,000 worth of work, and then a $5,000 contingency for overruns. So one of the items is, all right, we've got $2,500 for a bathroom renovation. That would include tile and a new vanity and a new bathtub and whatever else you might need. So it's $2,500. So your project manager is going to go out and get some estimates. Depending on how you write your agreement, they may only need 1 or they might need 2. They get their estimate, they approve it because it's part of the budget. It meets the budget, comes in at $2,400. So the project manager says, great, done, do it, and they go. Well, then the work gets completed, the project manager verifies that it's completed, and then when it's verified, they send the invoice to the bookkeeper for it to be paid. So the checks and balances there are, one, it hit the budget, it was within budget. Two, the work was completed and verified personally by the project manager, the person who has the responsibility. And then three, it was sent with the project manager's approval to bookkeeping for payment. So the nice thing is it really has some good accountability, that it really drills in what the job of the project manager is, that it's not the bookkeeper's responsibility to verify the work was completed correctly. It's not the investor's responsibility to verify that, that it was, meeting the expectations or it was the right color or any of that stuff. No, it's the project manager following the budget, their guidelines, it's their responsibility, it's their job to manage the project, and they've approved it. So if that goes wrong, let's say they approved the work, it came in over budget, and it was over that guideline as to when you needed two estimates. Let's say the project manager only got one estimate, they spent $3,500 on the repair, and it really wasn't done correctly. The perfect storm of it didn't work, it didn't work, it didn't work. Well, they're going to send the bill to the bookkeeper, and it's not going to meet the requirements. It's not going to meet the budget requirement. It wasn't necessarily approved by the project manager. At least it wasn't done correctly. And now the bookkeeper is looking at it as like, well, I can't pay this bill. So it gets elevated as an issue. And that's, that is an accountability thing. It's a stop dead in your tracks so that this doesn't go off the rails too far. It's like a squeaky wheel as opposed to the wheels falling off. Because way too often, that is a problem that shows up, the investor never learns about it. And then they compound it because they don't just go over budget on the bathroom, they go over budget on the kitchen, on the landscaping, on the driveway, and then the roof falls apart and you're 50,000 over budget, and the investor had no warning. The bookkeeper had no warning. The project manager says, hey, I'm here doing this every day, you're not, and this isn't my fault. And you can see how it just gets really contentious really quickly, as opposed to $1,000 overrun that gets nipped in the butt. Hey, John, why didn't you get multiple estimates? Oh, well, I'm so sorry, and this, we wanted to get done quickly, but these guys are great, and we have the contingency. I'm so sorry, I'll never let it happen again. Great, let's move forward. You can see the difference. Allowing something to balloon into a portion where you don't make money and you ruin your relationship with your partner, or a mistake. We can handle mistakes. Mistakes are okay. Disasters that you lose money on investment, not okay. I think you can tell the difference. So that's number two. Number three, checks and balances. So though you may choose to partner with an expert, see how I put that in parentheses, or in quotations, make sure to install checks and balances to ensure the project is progressing and money is being managed wisely. This is probably just a continuation of what I was talking about earlier regarding the bookkeeper's requirements. So here's the example that I wrote up here. So hire a third-party bookkeeper with rules for payment. Must be within budget. Project manager must verify the work has been completed, or maybe initial before the invoice is sent. Invoice submitted for all work to be paid, and then two estimates for work over 2,500. So that's the roadmap. That's how you do this so well. And you could do this with your spouse, honestly. You could say, look, honey, I really want to do this. I'm excited to. I think I'll be good at it. And just to build that confidence in you, I have to stay within this budget, and anything over 2,500, I need multiple estimates. And it allows you to kind of move speedily. Now, if your project manager decides to get multiple estimates on every project, so be it. I think that's awesome. But we're not going to require that. We want speed, we want efficiency. We don't want to kind of be dragged into the mud just trying to save a penny. Because here's the other side of it. The investor is making money every day the house doesn't sell, because they're getting a pref, or a preferred rate of return. So the project manager is encouraged or motivated to get this done quickly, on budget or under budget, because if the project manager gets this done a month early and 10,000 under budget, you're going to save a fortune in money that you would have to pay the investor. And so that's a win. And for the investor, I know they're going to make a little bit less money, but there's less risk. You sell and get your money back a month early, your return might actually be better because of the timing of it, and your appetite for more deals is going to be better. So it's a long-term game to motivate people to all be on the same page. Here's another example. So visit the property, maintain a proper chain of pictures and status reports. I even recommend this for a builder. So let's say you're buying a new construction house. I don't need you to be there every day. You're the homeowner. You don't know construction, but you want basically a status report weekly. So every Friday at 3 p.m., the builder is supposed to give you a status report. We have a 10-minute conversation with pictures, budget update, any problems. Do the same thing with your investment. Every Friday at 3 o'clock, we're going to jump on a phone call. If we can't do the phone call, I'll email everything, but here's some pictures, here's the status update, here are the invoices that were paid, here are the overruns, here's the update. So again, it's the whole point of not letting things balloon into a disaster, that you're kind of nipping it in the butt and keeping people accountable. Another example, specify the terms of a member performing repairs themselves. This is something that is very problematic. So we talked earlier about, if we could save money, that the parties end up doing a little bit better. So the developer or the person who put the deal together is going to make a little bit more money because they don't have to pay as much on interest or on profit sharing or whatever it may be. There's more money to go around. And they may decide to go and do the work themselves. Oh, it's just a bathroom. I'll do the tiling myself. Or I know how to fix plumbing. I can do that. Or I can do drywall. But if that wasn't the agreement, if you didn't want this other partner to be doing the work themselves and pocketing that money, it needs to be specified. If the intent was for them to do a lot of the work, then that needs to be specified, that we need to motivate the person to do the work themselves. And if they are going to, they have to get at least 1 or 2 estimates from other parties. So, if they're going to redo the whole bathroom themselves and they're going to charge $2,500 because that's what the budget is, well, then I need 2 estimates that show that budget was correct, right? And maybe one estimate comes at $2,400 and the other comes at $2,600, and it gets presented to the investor and says, look, here are the 2 estimates. I'm right in the middle. I would love to do this myself, and it would help me because I'd be able to make a little bit more money on the deal. Sounds good to me. Make sure it's done correctly, and you're not going to get paid until it gets verified, just like we do with everything else. So that's the checks and balances. Friends and family, we talked about this already, needs to be in writing. Clearly defined roles means you must define them, and here are some examples. So John shall manage the day-to-day operations at the property, which includes but is not limited to hiring contractors, approving invoices, updating the members of the weekly progress. In the event John is not able to be present on a particular day, he shall provide notice to the members at least 2 days prior to his absence. That is something I learned the hard way. When I had some clients, the deals started to not make sense. They had some overruns, and the project manager started getting other opportunities to make money elsewhere. And so the project manager is like, all right, well, I'm just going to leave. I'm going to miss today. I'll miss tomorrow. I'll be back next week. And then they miss a week after that. So by putting it in here, John's now in default. So if John says, hey, I'm at another project, we're stalled. It puts some sort of teeth in there to say, John, you're defaulting on your requirements. You didn't have to put money in, but you did have to be there every day. I'm taking the property back. Or maybe we have some other remedy in there. Letter B, Sally shall manage the finances of the company, which includes but is not limited to paying approved invoices, maintaining a running budget, keeping records of insurance and paid receipts, and providing quarterly statements to the members. You can see how valuable that could be for us, to have someone that is solely focused on maintaining records, so that I've always got something that I can look at and see what we've spent to date as compared to what we've budgeted. Letter C, Christian shall have no responsibility to manage the property or the project, maintain budgets, or guarantee any non-payment by the company. He is solely a limited or silent partner. Obviously, I put my name in there because I don't want to do anything. I'm investor. I'm not going to be there every day. I'm not there approving invoices. I'm not there approving that the work was done correctly or pushing you on the timeline. I'm just picking up a check. That might be great for you. And if that's all you expect from your partner, put it in there. And if that's all the partner expects, it better be brought up. We need to make sure that that's part of it. And we talked about this other thing, commission. So if applicable, incorporate the right of one of the members to exclusively list the property for commission, the percentage to be incorporated. So just like if it was a divorce agreement, specify who they want the real estate agent to be. And if that's going to be you, put it in there because that's real money. You don't want to have to be worried about it or having to convince them that you're the right pick. Put it in there up front while you still have some negotiating power. If they don't want this deal and pay your commission, I'm going to bring it to one of my other investors, or I'm going to do it by myself. So it's a really, really important thing, and you can use that for anything. If you're going to lease the property, you want to be the leasing broker, or maybe you're not accepting a commission and you're going to put that in there, or maybe it's a 5% commission, but you're not going to get paid until the end. So you're not going to take it on the purchase. You're only going to take a commission on the sale. And it could be a 10% commission. It could be a 30% commission. Doesn't matter to me. You can put whatever you want in there, but you can do any sort of things. I've had some other partnership agreements that basically say that we are going to pay out in a certain waterfall. So basically it would say we're going to pay off any fees that are owed on the property. So commissions, loans, back taxes, maybe contractors. So all the expenses get paid first. After that, we're paying Bob his investment back first, and then whatever interest he's owed on that. And then Sally, she's going to get her money after that. Or we're going to pay back all the investors first, their principal balance, and then we've got a pot left that gets distributed this way. So 20%, 20%, 60%. You can do it anything. And also the nice thing about this is that you can modify it at any time. So you buy this house, you're planning on fixing it, flipping it, selling it, and then you decide, you know what, we got a great renter. The market's not so great. All the investors are on board for extending this and renting it for 2 years. And then we'll get our investment back later. Well, let's modify the agreement. Let's change the partnership agreement and just say, hey, now all members agree that we're going to rent the property and profits are going to be distributed in this fashion, including when it's a rental. I usually like to keep money set aside for repairs and taxes and insurance. And if it's a fix and flip, you might not have to do that, but on a rental you would. So you're going to set aside, something in the agreement that says at any one time there should be no less than $2,500 in an operating account in the event that there are unexpected repairs, or there's a home warranty on the property that should cover repairs, or because we paid cash, taxes are going to be due in October, so starting in August we have to collect $500 each month so that there's enough to pay the taxes in October. And that you would have the right to keep that money before distributing it to the members. Another thing we see, distributing to members on like a quarterly or even a yearly basis as opposed to monthly. Now that can change, how attractive the deal is to an investor, but there's a big time commitment to writing checks every 30 days. It's a little overwhelming. So I would probably recommend, if you are going to rent it with investors, that you do it quarterly in the very least, so that you're not writing checks every 30 days, you're writing it every 90 days. And it allows you to build up a balance in the account and distribute, once you know what all your costs are, at least as best you can. And then the last piece, this is the last piece, if something changes, say you lose a renter, or you start to lose money on the deal, you need to know what happens if you can't afford it anymore. If the partners aren't into it, if you're not into it, if you want to be bought out, if you want to sell, there has to be a function in the partnership agreement that allows people the ability to sell. And here's a good example of that. You write into the agreement saying, if any partner requests to be bought out or to sell, the first option is any of the other members have the right to buy them out at a predetermined price. And maybe it's based on an appraisal amount, maybe it's based on the budget, maybe, depends on the type of deal and the context of the deal, but the members have the ability to buy them out first. So if you're my one partner and you say, you know what, I'm going through a divorce, I need out, this isn't working for me, I thought we were going to flip it and now we're renting it, buy me out. And I said, great, I'll buy you out and I'll refinance it, put entirely in my name, use the funds to buy you out. Or maybe I buy you out in cash, or we convert your equity into a loan and I pay you back over the next 24 months. There are a lot of options, but you can build that in up front. And then if the other partner isn't willing to buy it, then it has to be listed for sale. That simple. You cannot keep a partner captive forever. Maybe you don't allow them to put it up for sale anytime less than 24 months. And so you're basically handcuffing your partner and saying, we are in this for minimum 24 months. You cannot force me to sell the property. But after that, you can. If I'm not willing to buy you out, after 24 months, we can sell the property. And this is how we will do it. We will either mutually agree on a price, and you're going to be the listing agent or whatever it is, or we'll have to get an appraisal, and the price will be based on the appraisal. And then you can have a waterfall of, if it doesn't sell in 30 days, we lower it by 2%. If it doesn't sell in 60 days, we lower it by 5%. You can see how it can get pretty complex, but it starts with you and your partner discussing it, having a truthful, honest, in-depth discussion. Talk to the gorilla in the room. Don't just ignore him. Bring him into the conversation. Say, what if? What if? And having a very honest and open discussion about it. It's just an incredible opportunity. Now, I'll give you a couple of scenarios. This is the fun part of the class where it did not go so well. And feel free to raise your hand if you wanted to offer any advice or if you have a question about it. But scenario number one, there are two partners, a investor and a real estate guy. That's our favorite term, real estate guy. The investor, he's investing not just to make money, but he's truly interested in real estate. And you'll see that amongst your clients, amongst your partners, all that. They have an interest in learning about real estate, whether they've been watching HGTV too much, or they just read about it in the newspaper or whatever it's coming from. Maybe their parent was in development or something. They think this is really cool and they want in. And so they're willing to invest in you because you are the expert. I had that scenario. The investor had, I think, an inheritance of some sort, invested a couple $100,000, got a loan from a hard money lender. I think they went a little bit overboard. They bought like 5 properties and they paid $100,000 for each of them. And then they had a budget of $50,000 or $60,000 on each of them. So it was a good amount of money that they were investing in this property, maybe $700,000, $800,000. And there was the real estate guy, there was the investor. They were supposed to split the cost 50-50. But almost immediately, the real estate guy never held up his end of the bargain. The investor seemed to be the only one paying in. And then the real estate guy would give 10,000 here. And then the investor would put in 50. And then the real estate guy maybe 12,000. It was never 50-50. And they let this go on. They were seeing some progress down at the site. Real estate guy was managing it day to day. And all of a sudden, the investor gets busy at work and busy with family and all that stuff. And he kind of disappears for long stretches of time, a week here, a month there, 3 days there. He just comes in and out as he chooses. And after like 8 or 9, 10 months, he comes and he's just had enough. He's like, this property is a mess. There's no progress. We're 50% complete and you've spent 100% of the budget. And it's not just one of the properties, it's all 5 of them. And the real estate guy, he stopped showing up to the sites because there's not enough money to keep building. His contractors weren't getting paid, and it was ugly. And they started suing each other. They tried to mediate, they tried to meet in a room, and they just saw it differently. And I'll tell you why. You already see what the investor is seeing, that we're over budget and not completed, we're not fitting our time frames. But the real estate guy is looking at the other side and saying, you're never here. You're like the person behind the curtain pulling the strings, and you're funding the account, and then you're draining it, and you're funding it, and then you're draining it. You're stopping credit cards. It's like, I can't work this way. You're not paying invoices on time. And so I'm going to go make my money elsewhere. I'm going to drop this project and I'm going to go somewhere else. Well, the investor is the one who signed on the mortgage. And the investor is the one who's invested 90% of the money. And he's the one seeing no progress. He doesn't really care that the real estate guy, thinks he should be there every day. But their partnership agreement wasn't clear. It didn't have specific roles and requirements like we've been talking about. And so the thing just allowed itself to balloon and get ugly. The real estate guy had the credit card, and he was buying stuff at Home Depot, thousands of dollars at a time. The investor was just not keeping good tabs. So he only had himself to blame. I mean, he wanted to blame the real estate guy, and he certainly had the right to, but he had himself to blame just as much because he allowed it to go and become a major issue. Fast forward, investor guy filed for bankruptcy. The properties were sold at foreclosure, and not only did he not make money, but he got ruined financially. That was really ugly. And it doesn't have to be 5 houses and an investor guy. It only takes one to do that to you. It can be really, really bad, because if you're borrowing and you're guaranteeing that note, it's a problem. It's a major problem. If you miss a deadline, every month you have a mortgage payment due. Then you have taxes due. Then you have insurance, and it's a vicious cycle that if you don't have a way to fund extra cash just to get it done or to buy out your partner, you're really in trouble. So here's the second scenario. This one's similar, incredibly similar. Investor guy, real estate guy. They buy a duplex in Atlanta, and they convert it into 2 condos. So they want to sell the 2 condos at a profit. So they bought the duplex for like 200 grand. They were going to put 200 grand into it, and they were hoping it'd be worth 500,000 or 600,000. It would take them 5-6 months to do. And they, the investor guy, they were friends. The investor's always been in, he's never done real estate, but he's always been interested. He has a checkbook to prove it. So they sign an operating agreement. They sign a partnership agreement, and then they go on their merry way and they start building. The investor is funding 100% of the deal, so it's very easy to know what the roles were. Real estate guy is managing the day-to-day, hiring contractors, all that. The investor is just funding the construction, and he had guaranteed, I think it was $250,000 for the budget. Well, he comes back to me like 8 months later. The house is not complete. It's like 90% complete, but he spent $600,000. 600. 3 times the original budget. They never modified the agreement. They never changed any of the bookkeeping, any of the questions. He really wasn't there every day. I think he had some trips that he had to go overseas for work and all this other stuff, but he would come back, and maybe it was brewing over the whole period, but at the very end, he exploded. And the investor, he's just like, this is awful. This work isn't done right. It's way over budget. What the saving grace on that deal was that the property, if they could complete it, was going to be worth $1 million. So there was still profit. And the other benefit on that deal is that the investor had more money. They could just tap deeper into their pocketbook. And what they ended up doing is buying out their other partner, saying, hey, look, You've totally mismanaged this project. You've spent way too much money. You didn't get any sort of approval to spend extra, even though I'm complicit and I funded. You allowed this to go out of bounds. You have to sell it to me or else I'm suing you. And it worked. So they negotiated a buyout. The real estate guy thought he was making, that the investor was making a mistake and all this stuff and he's being ridiculous. But the investor said, I'm buying you out and you're leaving and I'll finish it myself. Now, this is a guy who'd never done a real estate deal in his life. And he was going to take a 90% complete house and he was going to finish it. Do you think he did it? Do you think he was successful? Yes. Terribly successful. He did a great job. He bought out, he still owns it, but it's worth $1 million. He didn't make as much as he would have made if he was more cautious, but he did it. So I hope that was helpful. I have a lot of stories like that, and I hope none of them are coming from you. But we'll have more of these classes going forward. And I'm very grateful to be able to teach them to you. And I hope that if you have questions, you just reach out to me.